Good morning. It's Tuesday, the 11th of November, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital. Our top stories and themes why Indian markets are recovering right now. Goldman upgrades India, reverses an October 2024 downgrade. Quality control orders and the unease of doing business. More action in India's weight loss drug space, and why Indian restaurants in New York are facing tariff pains.
This is the Core Report with Govindraj Ethiraj.
It's earnings growth. The big theme right now is earnings growth. We will come to India in a moment, but this is a global story. As we pointed out earlier as well, most economies in the world are on actually a fairly strong footing as our company results, contrary to expectations of a tariff impact across the board. Corporate America's profit growth remains robust. In fact, companies in the S&P 500 index that have reported earnings for the third quarter, about 80% of the index by market cap, have grown the bottom line by close to 15%, effectively doubling what analysts were expecting, according to a Bloomberg report, which also says that even with all the macroeconomic headwinds, which increasingly include the effects from the longest government shutdown on record, analysts have been raising their expectations for fourth quarter profits, according to that report, which adds that the momentum of earnings revisions, which measures the ratio of upgrades versus downgrades, is hovering near the highest level since the week of April 11th, according to Bloomberg intelligence data. What this suggests is that Wall Street believes in companies' ability to deliver stronger results over the next year. The presiding theme right now, of course, is the US government shutdown, which looks like it could end, and thanks to which global shares rose on Monday and government bond yields rose and the dollar steadied. Meanwhile, in the US, airlines cancelled more than 2,800 flights and delayed more than 10,200 on Sunday in the third day of government-mandated flight cuts due to rising air traffic control staffing shortages after thousands of delays and cancellations on Saturday, according to Reuters. Meanwhile, everyone is watching carefully for signs on how long and how strong the AI frenzy will last. Any let-up in that will affect stock prices and flows worldwide, including India, though India may benefit positively, but that also depends on who you ask. Bloomberg is reporting that Taiwan Semiconductor Manufacturing Company, that's TSMC, has reported slowing growth in monthly revenue, even as industry biggies like Nvidia are chasing more chip supplies. The company posted a 17% rise in sales for October, which seems high, but that's the slowest pace since February 2024. And that brings us to India. The major indices snapped a 3-session losing streak on Monday, thanks to those positive cues that we referred to earlier. But more importantly, the domestic earnings story is looking stronger, and we will have an exclusive interview on this theme tomorrow, so stay tuned. Meanwhile, Goldman Sachs has upgraded Indian markets back to overweight a year after downgrading to neutral and estimated a 14% jump for the Nifty by the end of 2026, thanks to strengthening earnings momentum and policy tailwinds supporting growth, according to Reuters. So therefore, as we said, Goldman has reversed its October 2024 downgrade and is now looking at a 2026 year-end target of 29,000 for the Nifty 50. The index has risen about 8.5% this year, but that lags other emerging markets, which of course have had one of their strongest years. The Sensex on Monday closed up 319 points to 83,535, and the Nifty 50 was up 82 points to 25,574. The broader markets, Nifty Mid-Cap Index was up 0.47%, and the Nifty Small Cap Index was up 0.3%. And gold prices are inching up again. They were up 2% on Monday, hitting their highest level in 2 weeks, thanks to economic data, which raised expectations for a Federal Reserve rate cut next month, and a softer dollar provided more support to gold. Spot gold was up about 2% to $4,078 per ounce Monday morning, hitting its highest since October 27th, according to Reuters. Unemployment falls. India's unemployment rate fell to 5.2% in the July to September quarter from 5.4% in the previous 3 months, thanks to increased rural employment during the farming season and a rise in female participation, according to the Periodic Labour Force Survey, or PLFS, released by the Ministry of Statistics. Now, this survey covers about 564,000 people and has estimated that there are 562 million employed persons in that quarter. The overall labor participation rate, or labor force participation rate, rose to about 55.1% from 55% in the previous quarter. The female participation rate was up to 33.7% from 33.4%, continuing an upward trend in women's engagement in the workforce, according to Reuters. And before we continue, join us for the third edition of our partners Algorand India Summit on December 6th and 7th, 2025 at ITC Gardenia Hotel, Bangalore. Registration link in the show notes, and let's get back to the show. Import barriers. A global trade research initiative analysis has argued that policies meant to help India's steel industry are actually exacerbating structural weaknesses and hurting small players instead of helping them. The analysis was responding to a government official's argument earlier last week that steel prices, which had fallen to 5-year lows, were forcing nearly 150 small producers to shut down and another 50 to halve output. GTRI quotes the government official saying government intervention through import duties and quality control orders was essential to protect domestic manufacturers from dumping and substandard imports. Now, GTRI is arguing that the current crisis is not driven by cheap prices or imports, but rather by import restrictions themselves. The QCO, or the Quality Control Order regime, has come in for a fair bit of criticism by Indian importers and industry and has restricted access to imported inputs, compelling smaller firms to buy domestically at high, often monopolistic prices set by a few dominant producers, according to GTRI. And GTRI further says that many large steel companies are posting abnormally high profits and there is no real injury to them. The GTRI says the supply scarcity caused by these orders and not low prices is forcing many small enterprises to shut down. So the issue of import duties on steel came back into prominence after the government imposed 12% safeguard duty on steel imports. The steel industry has been saying for a while that they've been hit by dumping from China, where factories have been running at cost or even below cost. However, GTRI's point is that imports account for less than 8% of India's steel consumption, and most of these are specialized grades not produced domestically. The issue, it says, lies in policy overreach. The combination of safeguard duties and expanding QCOs has raised input costs, created uncertainty for downstream industries, and weakened export competitiveness. Now, one of the other problems that's been pointed out by GTRI and others, including economists and trade watchers, is compliance testing, which is expensive and time-consuming. And that affects smaller importers more than perhaps others, because compliance testing means the testing has to be done physically and on location, and that could be somewhere overseas as well. I reached out to Ajay Srivastava, founder of the Global Trade Research Initiative, and I began by asking him what needed to be done to ease the QCO burden on Indian importers. Mr. Srivastava, thank you so much for joining me. So a high-level committee headed by Niti Aayog member has reportedly suggested scrapping or deferring more than 200 quality control orders issued under the Bureau of Indian Standards Act. This is according to a Business Standard report that appeared yesterday. Now, the number of products used to be less than 100. About 10 years ago, there are more than 800. And I've just talked about steel and your GTRI's comments as well on this. So what is the way forward? How do we make this work?
Govind, I'm very happy with the Niti Aayog recommendations. Of course, I have not read the full report because it's still not in the public domain. But I read bits and pieces of it from LinkedIn and other sources. It shows that industry was suffering. Government is responsive. Government is not blind to the concerns by industry. And government has come out with the recommendations, in the form of Niti Aayog, this report. And the recommendations are very straightforward, no nonsense recommendations. I have to see how much of these are being implemented.
In an ideal world, what would it mean? So, for example, to use the illustration of steel, which you had also written about earlier, and importing steel inputs for, let's say, downstream steel users in India, and the challenges of, let's say, doing the on-site quality testing or certification and so on. How would these new rules apply, if so?
3-4 things were hurting the industry very much on quality control orders. One, Earlier licensing regime was there. Anybody who could meet the conditions could import. No more. So the QCOs, the BIS officer will decide which of Indian party will be importing from which of countries, say China's one particular factory, who will supply. One factory can be allowed, another factory, neighboring factory may not be allowed without any rational justification. So what was happening was on the Indian side that many of the MSMEs they were sourcing from a particular factory, and those factories were never registered by the BIS. But some of the largest steel firms they were sourcing from say Indonesia-based JV, and they were allowed. What was happening was that even imports were always democratized in the country. Anybody who meets the condition can import. With QCO, selective people were allowed to import. That was the basic problem in my eyes, which was hurting the industry. Some of the big guys they were importing and they were selling the same material after some processing to the MSMEs after hefty margins. So that was the basic problem. Another problem was, steel ministry has gone too far. Even for the products on which they have not notified QCO, they say you have to come to us for taking NOCs. We will certify this product is not under the QCO. So there are 10,000 steel grades world over. They notified QCOs for 1,300. For the 10,000 minus 1,300, also everybody has to come. So goods were coming, they were lined at the port, incurring demurrage. People were suffering, and their systems were half the time not working. And all these things, they were hurting. So people went to the court, Madras High Court. They stayed the Steel Ministry order. Case went to the Supreme Court. It referred to the Chennai High Court. I think looking at all these, government took cognizance of this and came out with this report.
Right. Now, if we are saying that there are more than 800 or thereabout quality control orders, obviously that means very wide lineup of products. Is there an 80-20 rule here, first of all? Like most products are of a certain kind and would be covered here?
The committee, they just made a beginning. We have 790 QCOs which are already being implemented. Committee selected only 208. How they selected? They did not touch upon the finished products. They touched upon the raw materials, intermediates, and capital goods, the machinery part only. They left aside the finished good part. Because world over, no country, no US, no Europe, no Japan, they apply QCO type regulations on the raw materials or intermediates. It's always on the finished goods. But India, we have gone across the stretch and applied on raw material intermediates. And rightly so, this committee has focused on this most absurd part of the QCOs and recommended them to be knocked out.
If assuming these 200 or 208 are indeed removed, so how much of imports could be freed up potentially?
Products, people who are making them in India, they are few of the largest industries, very influential industries, and basically QCOs were helping them. So they will be going all out to ensure that most of the recommendations of the committee are not implemented. So government has to see not to come under any pressure, evaluate the recommendations and see what can be implemented. But I get from here and there that already process is on to dilute the recommendation, implementation of the recommendation part. So government has to ensure. Second thing is the committee has given a timeline. By 15 November, most of these have to be suspended or revoked. The timeline looks slightly premature because if government has to take call without considering, it's all right. But if government has to consider, because these will impact large amount of production, I'll give you just one example: synthetics. Now, synthetics story is, world garment industry. 70% of it is synthetics or mixed fabric. But our exports are only 30% synthetic, 70% is cotton. World is reverse. That's why we are nowhere in the winter wear market. Very sparse presence is there. Why? One of the reasons is restrictions like this. This alone is not responsible. Many other factors are there. But one of the reasons is that you don't allow, say, garment makers to import the fabric freely. Bangladesh, textile industry, no depth. All they allow is that, okay, you import quality fabric from Vietnam or China, from wherever you want. India, we don't allow. This QCO ensures earlier anti-dumping duties were there. They are thankfully gone, but now QCO is gone. So this ensured that India's presence in the synthetic sector is minimal. So I am sure if these are removed, and not only removed, as an investor, I should get the confidence and a word from the government, these will not be bought back for the next, say, 10 years, else I'm not going to invest in this. So not only you have to remove, you have to assure me these are gone for some time. Then only investment will start taking place. One particular sector, textile sector, will flourish. I mean, it will get a lot of impetus by just removal of these QCOs and few other conditions. And this same applies to steel and many others.
So, on the example of synthetics, I assume you mean man-made fiber. Are you saying that basically the import is being blocked to some extent by domestic manufacturers? Even if that were the case and domestic prices are higher of synthetic fiber or man-made fiber, why is it that the apparel industry cannot use that? Or is it so uncompetitive?
Suppose I am making garment using polyester fabric. Then for importing polyester fabric, the factory from which I am buying, they have to be BIS certified. If BIS is not certifying them or is taking time to certify them, then the local manufacturers will jack up the price for that. And industry will be forced, because of the scarcity of the imported item, to buy at higher price. If you buy raw material at the higher price, your finished good will be at the higher price and you can never be competitive. In the domestic market, that's one of the issues. So one of the uses of QCOs is to restrict, to choke imports. And then I can raise my prices of the inputs, and which domestic industry will be forced to buy from me. Else, without the QCOs or lower duties, they will be importing straight, as Bangladesh or Vietnam is doing.
Last question. So, suppose we were to start from scratch and maybe rewrite the laws here, what would be your primary recommendation or set of recommendations?
So I say QCOs are very important for any country to ensure quality consumer health, consumer safety. But look at what we have done. We were almost zero. I mean, less than 70 QCOs by 2016. In less than 8-9 years' time, we added 700. And sometimes we didn't do any study. We just notified. I am privy to some of the developments while I was in the government. Quotas were there for each ministry to implement so many QCOs. They have to be done on fast track basis. We forget that a continent like European Union, they take 5 to 10 years to notify one QCO. They do all sort of studies, big consultations. After that only they do it, and that's why they survive. Here we have done with little preparation. So I say QCOs are needed, but we have to look at them at 360 degree, whether they are for helping one particular industry or they will be benefiting the country. If they are benefiting the country, they are most welcome.
Mr. Srivastava, thank you so much for joining me.
Thank you, Govind.
Weight loss drugs. India's largest selling drug by value is now a weight loss drug, which was nowhere in the charts 6 months ago. And this is Mounjaro, as we pointed out yesterday. Now, Novo Nordisk has partnered with India's Emcure Pharmaceuticals to exclusively distribute and market its weight loss drug under a new brand in India, according to the companies on Monday. Under the agreement, Novo Nordisk, a Danish company, will sell Poviztra 2.4 mg semaglutide injection in India as a separate brand than its other weight loss treatment, Wegovy. Novo Nordisk launched Wegovy in India in June, 3 months after Eli Lilly launched Mounjaro, which, like we said, is the top-selling weight loss drug and the top-selling drug by value in India. Now, Wegovy's 2.4 mg dose is priced at about 26,000 rupees for a month's supply, and the pricing for Poviztra is not been revealed as yet. Last month, Eli Lilly also partnered with Cipla to sell its weight loss drug under a separate brand in India, according to Reuters. New York food. The 50% on tariffs from India into the United States are hitting New York restaurants. Chef and restaurant operator Salil Mehta, founder of Fungi Hospitality Group, which includes grilled meat specialists Kebab or Sharab on the Upper West Side of Manhattan, told Bloomberg that he has seen the wholesale price of a 40-pound bag of basmati rice climb from $30 to $45. Similarly, a 500-gram pack of chili powder that was about $7 now costs him about $10.50. The other problem, according to him, is that Indian and Asian restaurants are more vulnerable to these cost increases because they suffer from the stigma of being cheap cuisine. According to him, people don't mind paying $35 for specialist pasta, but there's a different perception that Indian food should be cheap already. Thanks to which, Mehta, like other restaurateurs, are increasing prices. At Lungi, which is a South Indian and Sri Lankan dining room, on the Upper East Side, prices for rice, lentils, and spices like ginger and garam masala are going up. Another restaurant, Passerine, in the Flatiron district, one of the few Indian tasting menu restaurants in New York, is also fighting higher prices. A bag of Arhar brand dal that was about $62 earlier is now $82. Ghee is up from $150 to $220. And they say that as a new restaurant and an Indian restaurant, we haven't felt that we have the wherewithal to raise prices. We know the impact that it can have on covers. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.